It follows that you presumably want to be a billionaire if you're watching this video. Similar to Warren Buffett, however, whether you believe it or not, you actually have a significant advantage over Buffett when it comes to producing profits if you have a very small amount of money in your portfolio. You have the benefit of not being a billionaire. In this video, I'll show why having less money in your investment portfolio than Buffett can actually help you earn better returns than the renowned Oracle of Omaha. Okay, I'll admit, that statement doesn't seem very compelling when you first hear it. Buffett's net wealth is over $100 billion at the moment, but that wasn't always the case. Buffett grew up in Omaha, Nebraska in the 1930s and 1940s, a long way from the thriving global financial hub of the time. His family was middle income, and he didn't begin his investment career with a trust fund. This implies that at one point, his investment portfolio only contained a few relatively small quantities of money. Buffett's biggest returns throughout his career really came from managing money for rich Omahans in his 20s and 30s. Quite different from the $650 billion business he currently controls. It's crucial for those of us investors who don't yet have billions of dollars in our investment portfolios to learn how Buffett made his investments at this time. Because a lot of labor goes into making these videos, be sure to hit the like button and subscribe button. Let's listen to Buffett's comments now.
We will always have enough cash around, but anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash.
Advantage number one, you don't need to commit a lot of money. The market capitalization of Warren Buffett's company, Berkshire Hathaway, is at $660 billion. What size investment do you believe Buffett would need to make in order to, as he puts it, move the needle? Let's just say that an investment needs to account for 10% of the total worth of the firm in order to have a significant impact on the company's performance. In order to reach the 10% level, the investment would need to be around $65 billion or $70 billion in value. Let's take a look at some businesses that are currently valued in that region in order to put that into perspective. General Electric, one of the most recognizable businesses in the world, is currently valued at over $80 billion. At this time, Airbnb is worth $70 billion. FedEx, a firm that delivers packages, is currently valued at $61 billion. Ford's market value is $58 billion. Considering that Marriott, a hotel company, is currently valued at $52 billion, all of these businesses are tremendously enormous. However, for Buffett to make a truly significant impact on Berkshire Hathaway, it would take him to purchase one of these enormous businesses, or an elephant-sized acquisition, as he puts it. This reduces the number of prospective businesses Berkshire can meaningfully invest in. As Berkshire grows bigger and bigger, Buffett's investable universe gets smaller and smaller. Consider a person investing on their own who has a much smaller amount of money. Using the same 10% criterion, we can say that an investment must represent 10% of this person's net worth in order to be considered noteworthy. This investor's pool of potential investments is virtually limitless. The largest corporations in the world, all the way down to his local little business, are all eligible for investment by this investor. Our individual investor is significantly more likely to identify an undervalued investment because the pool of prospective investments is wider. This dynamic is perfectly shown by the investment in the Delta Duck Club that Buffett mentioned. When the Delta Duck Club discovered that the land its members owned actually had lucrative oil underground, it quickly transitioned from being a hunting club to a company. Only 98 shares of this firm were ever issued. Each share was valued at $29,000, represented $20,000 in cash, and generated an annual after-tax income of $11,000. You are essentially paying $9,000 for an investment that netted you $11,000 after taxes after taking the $20,000 in cash out of the $29,000 purchase price of the share. In the world of finance, this is what is known as a no-brainer, but there is a key qualification as to whether it is a wise investment. The size of the investment portfolio will determine the answer. If Berkshire made this investment right now, it would barely account for 0.000004% of the company's market capitalization. In all honesty, Buffett's time wouldn't even be worth it if he made this investment, which would amount to absolutely nothing given how small a part of Berkshire's wealth it represents. Simply put, it wouldn't make a difference. On the other hand, suppose we have a private investor with a $30,000 total investment portfolio. For him, this investment in Delta Duck Club would be fantastic because it would account for a big chunk or almost all of his net worth. With a relatively small investment, it would effectively move the metaphorical needle for our investor. This brings us to the second benefit of making tiny investments. Advantage number 2, less rivalry. Generally speaking, in the realm of equities, there are more investors attentively following the company as it grows in size. The less likely it is that a stock is undervalued, the more investors who paid close attention to it. Naturally, there are exceptions to this rule, but in general, it is valid. Use Apple as an illustration. Thousands, if not tens of thousands, of knowledgeable investors closely track Apple stock. These investors work with some of the most well-known hedge funds and investment banks in the world and are graduates of prestigious colleges. Apple's current market value of $2.6 trillion reflects its magnitude. It attracts a lot of attention, and a lot of intelligent people keep up with the business's every move. Due to how closely people follow the company, there's a limited chance that Apple will become significantly undervalued. If a stock were only worth, say, $100 million, investors would naturally pay less attention to it simply because of its smaller size. Compared to a huge corporation like Apple, the stock probably only has a tiny fraction of the followers. Smaller businesses are more prone to have their values misjudged by the market as a result of this dynamic. Because there's greater opportunity in smaller-sized companies, Buffett stated that if he were managing tiny sums of money, he would concentrate on investing in them. The less competition there is, the better if your objective is to identify inexpensive stocks. I am aware that the majority of YouTube videos discussing Warren Buffett's investment ideas aren't the most useful. That is to say, there aren't many concrete bits of advice that you can immediately start incorporating into your own financial strategy. I hope to be able to provide you some practical advice in this video that you can use to start expanding your portfolio. Please like this video if you enjoy this strategy since it encourages me to continue producing these films. So, for my analysis of Buffett, I provide the following 3 pieces of useful guidance on how to invest modest sums of money. To look where other people aren't is Buffett's first piece of advice. You have the advantage of being able to invest in things that are just too little for big institutional investors when you're investing small amounts of money. Don't lose that advantage by continuously attempting to compete with these powerful players. Place your attention on investment opportunities that are simply too little for investment funds with billions of dollars to find meaningful. One concrete illustration of this may be hunting for equities in particular nations that aren't well-liked by institutions. Professional investors frequently concentrate on stocks with American roots. However, there are many excellent businesses throughout the world that may be undervalued in comparison to their American rivals. Focusing on smaller businesses is the second piece of advice. Warren Buffett has previously stated that he would spend his time concentrating on smaller companies since they are more likely to be bargains in this section of the market if he were managing a lot smaller amount of money. Other reputable investors, like Peter Lynch, agree with this sentiment. Lynch coined the phrase 10 baggers, which refers to investing in a stock that increases in value by a factor of 10 after your initial purchase. The dream of every investor is a 10-bagger. He has mentioned how much simpler it is for a small business to 10x than it is for a large one, and this seems logical. Going from $1 billion in sales to $10 billion is a lot simpler for a corporation. The next step is for a corporation to increase its sales from $100 billion to $1 trillion. It becomes more difficult for a corporation to continue growing at the same rate as it grows larger. The next piece of advice is to look in so-called inefficient markets. When an asset price does not accurately reflect its genuine value, a market is said to be inefficient. Using an example of a market I personally invest in that is inefficient will help best illustrate what I mean. I invest in real estate in a specific big city in the Midwest of the United States even though I live in the New York City area. I can purchase a rundown piece of real estate in the city and pay to have it renovated. The total cost of the renovations plus the acquisition price of the house is still much less than the price of a newly refurbished property. An illustration of an ineffective market is this one. I might spend, say, $90,000 to refurbish a property I purchased for $80,000, making my overall investment in the property $170,000. In this real-world example, the house is worth $280,000, thus I made a profit of $110,000 on my $110,000 investment. There are many additional so-called inefficient markets, but this is just one, so there you have it. I sincerely hope you gained something from seeing this video, and be sure to view the other one on the channel. I have no doubt that you will appreciate this video as much as the other hundreds of thousands of viewers have. Additionally, I want to offer you as much value as I can. Please like the video and subscribe to the channel if you find that to be admirable. I look forward to speaking with you soon.